There's a huge difference between businesses that are capital light and businesses that are capital heavy. And if you take some of the businesses and look at their charts over a long period of time, I mean 10, 20 years, and you compare the stock prices of the businesses that are capital light versus the stock prices of businesses that are capital heavy, you will clearly see the difference, which ones are good and which ones are not. If you're new to this channel, my name is Mariusz Skonieczny. I run Microcap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote 10 books on investing, one of which is available for free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a more intelligent investor. One of the most important skills that I got from Warren Buffett is to be able to pay attention to businesses that are capital heavy and capital light, and the kind of difference in investment performance or stock market performance or value performance that capital light value businesses can generate versus the capital heavy businesses. So think about companies like oil tankers or oil and gas companies, beloved gold mining companies, or any other very heavy, very capital heavy investment, very capital heavy businesses. Look at their stock prices over the last 20 years. Look at them. They don't look that good. Or punch in any ticker symbol for an airline company, which is very capital heavy because somehow you have to buy these planes, right? And it's a business that doesn't have any pricing power, faces a lot of competition. The stock prices don't look that great. And then if you look at businesses like, for example, Moody's with the ticker symbol MCO, or Winmark Corporation, which is the owner of Plato's Closet, you look at the charts of these companies and it's just like, whoa, it looks absolutely fantastic. And that's because businesses that are great, that don't require a lot of capital to grow, can make you very wealthy as a shareholder. And talking about a company like Winmark Corporation, which again is the owner of the brand Plato's Closet, where people go to buy used clothing, right? Think about how wonderful the business is. You see, you think of Plato's Closet as a retail location. And retail location, that doesn't sound like a great business. But Winmark Corporation doesn't open the retail locations. They are in the business of selling franchise licenses. So in other words, you can open a retail location, Plato's Closet, and you have to pay Winmark, a one chunk of a payment for the franchise. And then you have to give them a percentage of your sales, because that's how franchise operations operate. So from the point of view of Winmark, they get your money for the franchise operation or franchise unit, and then they get a percentage of sales. Like, how much do they have to do to get that from you? It doesn't cost them anything. They can open 1,000 stores, and it's very capital light type of business. If you're getting the franchise from them, you're the one that has to put the capital to open the store, to find the real estate location, to improve the location and all that. You're the one that's paying for all of this, not them. You're the one that has to get the inventory. You're the one that has to, hire people and all this. So in other words, the business itself might be capital heavy, but Winmark as a company doesn't have those expenses because those capital expenditures are carried by someone else, which is you if you open the franchise location. But the reason why Winmark was able to deliver such wonderful performance is because it can grow revenues cheaply and it doesn't have CapEx. How can we tell whether a company is capital intensive? Well, you look at all of the financial statements. So you look at the balance sheet, you look at the income statement, and you look at the cash flow statement. So on the balance sheet, what you pay attention is property, plant, and equipment, fixed assets, right? If you need a huge fixed asset to generate revenues, the fixed assets are going to show up on the balance sheet. On the income statement, what you look at is the big depreciation expense, because fixed assets, which is the definition of being capital intensive, when they are put on the books, they are depreciated every year. Okay, so that depreciation expense shows up on the income statement. And then on the cash flow statement, the cash flow statement is divided into three sections. It's an operating section, investing section, and financing section. In the operating section, it starts off with net income, that certain adjustments are made to net income. Like, for example, you add back depreciation, because depreciation is a non-cash expense. But it's an expense, but it's just non-cash. So it's getting added, then you make other adjustments, and then you finish the operating section with the net cash flow from operating activities. And then you jump to the next section, which is the investing section of the cash flow statement. And then in the investing section, you see things like acquisition of other companies, purchases of marketable securities, and things like that. But you also see purchase or sale of property, plant, and equipment. And this is where you see whether the company is capital light or capital heavy. So if you have a business that's stabilized, like big already, and has a nice operating cash flow that shows up on the cash flow statement, then you see what percentage of that goes for purchases of property, plant, and equipment. If a big portion of operating cash flow goes into purchases of property, plant, and equipment, like 80%, 100%, then you know that this is most likely a capital intensive business. And if you don't know, if you don't understand about anything that I'm just saying, that's why I created valueinvestinguniversity.com, where right now, as of the date of this video, there's 10 videos. And then the last 5 videos focus on how to read the financial statements, which means the balance sheet, income statement, cash flow statement. This is what I go over in detail in the cash flow statement, how to read it. And this is where I also go over how to read the capital expenditures. And Value Investing University is free. All you need to do is sign up with your account and you can get access to those videos. I used to sell those videos for about $500, but I realized it's probably better if I just let people get educated on this subject. So take advantage of it. If you don't understand what I'm saying, take advantage of it. Sign up, watch it, and become more intelligent. Now, one other thing that I wanted to say about the CapEx is that you can divide CapEx into 2 categories: maintenance CapEx and investment CapEx. So imagine having an apartment building. Obviously, being in the business of renting space to tenants, it's capital intensive. Why is it capital intensive? Because you have to build the apartment, right? It's not a website, it's not an app, it's not a software. You have to actually build the physical asset. That's capital intensive. The capital has to come from somewhere. But once you operate the apartment, in order to add more revenue, besides just inflation, you would have to build another apartment or buy another apartment, right? That's capital intensive, and that's CapEx. But that CapEx is actually good CapEx, because the lower the CapEx, the better. But there's a good and bad CapEx. If I want to grow and I buy or build two new units, that CapEx would be considered growth CapEx. Now, if on my original apartment building, something gets broken, like a roof needs to be replaced. That's not growth CapEx, because you need to fix that roof in order to maintain that business. If you don't fix the roof, then you're not going to be able to generate revenues anymore. You have to maintain that building. So fixing a roof is not just like fixing a toilet. Fixing a toilet is repairs and maintenance, right? That's an expense. That expense flows through the income statement. Fixing a roof, it's not a regular repairs and maintenance. It's considered capital improvement to maintain that building. So that would be considered a maintenance CapEx. That's not growth CapEx, because you're not going to be able to, double or triple your revenues by fixing a roof, but you're going to be able to maintain your business, maintain your tenant base by fixing it. So there's a difference between maintenance CapEx and growth CapEx. And unfortunately, companies don't break those out. All of it is put together in the investing section of the cash flow statement under purchases of property, plant, and equipment. Now, when you are calculating free cash flow or owner's cash flow, you take operating cash flow from the operating section and you subtract only the maintenance CapEx, and then you get your free cash flow. If you subtract the entire CapEx, which also includes the growth CapEx, you're going to get too low of a free cash flow, and you might miscalculate the free cash flow and you might miscalculate the value, because growth CapEx actually benefits you as a shareholder because it grows your revenues, right? It grows the number of clients. So growth CapEx could be considered the same as acquiring another business, right? So that benefits you, because at the end of the day, the bottom line of net income, of free cash flow, should be used to benefit you, whether it is to pay down debt, whether it is to pay dividends, buy back shares, or grow. And grow can come from acquiring businesses, or it can come from spending money on CapEx growth. So it's important to be able to differentiate between the two. And unfortunately, there's not the easiest way to do it. I mean, you can look at the balance sheet, you can look at the differences between depreciations, but probably the best way to do it is just to call the company and say, how much of your CapEx is maintenance CapEx and how much of your CapEx is growth CapEx. So these are just some of my thoughts on why understanding CapEx is important. From my point of view, I always like businesses in general that have low CapEx requirements, because the lowest the CapEx, the more capital light the business is, the more it can make me rich as a shareholder. So that's it for this video. I hope you enjoyed it. You know what to do. Subscribe to this channel, click on the notification button, leave me a comment, and like the video, and thanks for watching.